Now, economist and former Treasury Secretary Larry Summers has blasted President Biden's $1.9 trillion stimulus package, and he called it the least responsible economic policy in 40 years. Now, in his remarks, Summers said that we were being set up for, quote, a pretty dramatic fiscal monetary collision. So I want to talk about this now. I'm pleased to introduce Diana Furchtgott Roth. She is joining us now for this conversation. She's an adjunct professor of economics at GWU and served as a chief economist at the Labor Department. Now, she's also served in the Treasury Department and Department of Transportation under President Trump. Diana, great to have you with us. So first, I have to just ask for your comments on what Larry Summers had to say about the stimulus package. He did not pull any punches while criticizing that $1.9 trillion deal.
Well, that's right, Kristin. He didn't pull any punches. And I have to say that I agree with him, as I have agreed with him on many other matters. Last year, we had $3 trillion worth of stimulus. Not all that has been spent. And now we were growing at 4% last quarter. We're growing at about 6 or 7% this quarter. We're scheduled to grow at about 6% of GDP for the whole 2021. It does not make sense having another 1.9 trillion in stimulus, even though there are people who need help. They need help with unemployment benefits. There are the hospitality and leisure sector that's been completely knocked off. That group needs help, but they don't need 1.9 trillion. And there are many other things in the bill other than help for the needy, which we do need.
Okay, so the Biden administration did respond to the critique. It has been made not just recently, but several times throughout this proposal of the stimulus. The Biden administration said that, we aren't in danger of overheating the economy. I've heard other economists say that there is not essentially the danger of doing too much, but rather the danger of doing too little. So then how do we walk that line, or how should the Biden administration have either walked the line, or how should they walk the line going forward between this economy that is very quickly pivoting to strength while also helping the millions of Americans that are still very much struggling economically?
I think that we are in very great danger of inflation. We saw the Fed statement last week, and the Fed's trend GDP growth is 1.8%. The Fed's forecast was way above trend growth. It was 6.5% in 2021, 3% in 2022, but magically no forecast of inflation higher than 2.4%, which was going to be this year, and then 2% in 2022. So it's just remarkable that the Fed is not forecasting more inflation, even though it's forecasting a huge increase in GDP growth above trend, large decline in unemployment, but no inflation. And these numbers do not add up. We are going to be seeing inflation down the line, and we need to be concerned about it.
So what happens then when fiscal and monetary policy collide? Larry Summers said that they were on a collision course. What then?
Well, it's a question of how the Fed is going to adjust its policies, whether it is going to gradually raise different kinds of rates in order to avert massive inflation. So that's the question. How are we going to react when inflation picks up to a greater extent than it is right now? Right now, we've seen energy prices higher. We've seen yields creeping up. We've seen commodity prices higher. We've seen indications of inflation. The question is, as that translates through to the CPI and core CPI, how is the Fed going to react? They have the tools. The question is, will they be doing the job?
Now, this is something that we have been chatting about quite a bit, especially ahead of and then immediately after that FOMC meeting when the Fed decided to leave interest rates unchanged. And the big question that my colleague, Yahoo Finance's Brian Chung, had asked was essentially how optimistic is too optimistic for the U.S. economy? And it was something that I was chatting about with economists at the time, and the need for the Fed to essentially pivot from dealing with some of the headwinds headwinds in the economy to the fact that they are now changing and strengthening into tailwinds. So I want to throw that question over to you about how optimistic is too optimistic for the U.S. economy.
Well, I think that we have a lot of optimism right now. The question is whether we are going to kill the goose that lays the golden eggs with a new tax bill by increasing corporate taxes from 21 to 28%, raising taxes on top income earners, which include small businesses, and whether they are going to be ratcheted back to slow growth in terms of less investment. And we need to be very careful of not killing the goose that is laying the golden eggs. So we need to hope that the economy is going to go through powering forward and that the Fed is going to adjust to meet these new circumstances. As people get out, they start spending, they go traveling again, they go back to restaurants. Things are looking really good, building on President Trump's record.
All right, Diana Furchtgott Roth, Adjunct Professor of Economics at GWU and former Labor Department Chief Economist. Thanks for joining us.